one of the things that we see from exuberant salespeople, people who sell on energy, who sell on enthusiasm, and they're not listening to the client. They're selling on their passion and excitement for the sale. They're trying to close deals, and we see a lot of those not even get issued at all. And so we see agents that go out and write $12,000, $14,000, $16,000 in business, and we look at how much was issued the next week or the next month, and you realize out of that 12, 14, 16,000, only 4 or 5,000 got issued. But what happened?
Hey guys, welcome back to another episode of the Life Insurance Academy podcast. I'm here with my good friends, my fighting buddies, my men-at-arms, I could keep going. Do you want me to?
Is that minute-arms or men-at-arms?
Men-at-arms.
Because it sounded like minute-arms. I'm like, what's a minute-arm?
Those are little arms. Today we are helping you guys make more money. That's the whole point of this podcast, is to help you be more profitable. Do you want to make more money? I think you do. And one way is to keep more money that you've already made.
Well, they think they've made it.
Yes.
That's the problem.
That's the tricky part. So today we are talking about this I guess, swear word in insurance world. It's chargebacks. Chargebacks.
What does that even mean?
A chargeback?
I've always wondered, is it one word or two?
I don't know. I've never had one. So you guys are gonna.
You've
this is
clearly
your
not
podcast.
looked it up in the.
I'm out.
I'm pretty sure it's one word.
In the Merriam
It is.
Webster.
As I typed it as one word, and it's showing up that is correct. That's how I know it's right.
On your Grammarly?
Yes.
But to be honest, a lot of people on this listening to this right now probably have no idea what that even means, because when you get recruited into insurance or you look at this new industry for the first time, somehow that never comes up in any opportunity meeting or what to look forward to. It's
what to look forward to.
I mean,
it's not in the overview. It's not on the comp grid.
It's not.
No.
Like, you don't know what it is until you're scratching your head looking at your upline and going, I just made all this money and now I should be getting this large commission and I got paid $200.
What happened?
What's going on?
That's right. So what is for new agents, people who are looking to get in this industry, who want to make a lot of money, and yes, you do make a lot of money. We've talked about that many, many times in the podcast. Drive by the big buildings. They're all bank buildings and insurance company buildings, right? But there's still a segment of this. What is a chargeback? What do you say?
Well, a chargeback.
What say you, Zach?
Okay. So a chargeback is when us as insurance agents, we're going out and serving clients. We're taking care of them, and we get paid on a commission. That commission is typically advanced pretty much in any type of insurance sales, or mostly the simplified issue space. But they will advance you the commissions for a lot of times, 75% of the time, or 9 out of 12 months. Now, that's in good faith that the insurance company is basically saying that we anticipate and hope that this client is going to continue to pay these premiums for multiple years.
For the rest of their lives.
Right.
Yeah.
So instead of you getting paid a little bit each month, they're going to go ahead and give you 9 months worth of commission, assuming the client's at least going to pay 9 months worth. They're going to give you that pay right now up front, but technically that is not your money. It is.
But they gave it to you, Zach.
They're allowing us to hold it.
It's an advance. It's an advance on your commissions.
So if the client
functions as a loan.
It does.
Yes.
So if the client doesn't keep their policy for the time amount of money that you have been advanced on or that you're holding for them, well, then you have to pay that money back. And typically,
that doesn't sound very much fun.
It doesn't.
No,
but
that ain't fun.
Well, you didn't earn it. It's not yours, right? You didn't.
I felt like I earned it. I sat with them for 2
true.
hours. I was on the phone with them for an hour.
Exactly, and that's the feeling, and all of us here today don't want you to have that feeling.
Yeah.
And so we're going to kind of explain to you why this happens, what it is, and how to prevent it.
So as we're talking about this, what is It's inevitable. You're going to have them, and I have to confess to you guys, I lied to you at the beginning of this podcast. At the very beginning, I said I've never had one. I've had one. I'm just kidding. I've had as many as the next guy. But as we're talking about this,
I've had one.
as the number, what can you anticipate? Because I do think like all of a sudden you have people who may be looking at this and they're getting excited about jumping in. They're like, whoa, nobody told me about this snake bite that could happen, right?
Mm-hmm.
So what is the number? What can you anticipate for?
What do you mean? What's the
chargebacks?
number?
The number? What is percentage wise? What can you expect?
20 to 25%,
20 to 25%.
which means about 7 to
Can
8.
I jump? I want to jump. I mean,
Yeah.
I think that's industry standard probably in the simplified issue space. There are definitely individual agents who have a much lower chargeback rate or a much higher placement and persistency than that. I can guarantee you there is, but probably industry-wide, it's probably around the 20% number. So I don't want people listening and going, oh no, mine is only 12.
Right,
They're
no.
wrong.
Right.
Well, industry-wide, hundreds and thousands of agents, you'll see these numbers average out.
So that can be 20, 25, and that can go the other way.
It could, yeah.
Unfortunately.
Yeah, we've seen that too.
The simple way to think about it is 1 out of every 5 policies you sell, right? Or 2 out of every 10. So when you put it in terms like that of an agent, they're going, oh, well, I wrote 5 policies yesterday. Well, you can mentally prepare for maybe one of those not lasting that full year of the advancement of commissions that you received. So when you think about it like that, you're like, oh, okay. So that motivates me to work harder, it motivates me to get better, it motivates me to push through and get a couple extra apps because I know that some of these are going to fall off.
Right. So I guess that leads to the next question for us. These things are going to happen. They're unavoidable. Are there ways to mitigate?
Are they unavoidable?
Are they unavoidable? Yeah, that is a good question.
I mean, that was just a blanket statement you made there. They're unavoidable.
They are
No.
unavoidable. Well, you could not write business. That's one way to avoid them.
Yeah.
That's very
And
good.
that's what
Or
a
you
lot
could
of
be
agents
Chris
do.
and only get one ever.
Yeah, you could only be me and get one ever. So the question is, how do you mitigate it? And I'd rather be the agent that has a 90% persistency than the agent who has a 70% persistency, right? So one answer was volume, right? Increase your volume, get a couple more applications in the hopper, and you know that one of them's going to fall off. But what are some other ways? Is there a dial that we can control to prevent?
Well, there's probably a
chargebacks?
couple things. I think there's 2 areas here. Number 1 is a placement issue.
Okay.
Number 2 is a persistency issue. And I think they're different. I think placement has to do with almost an immediate decision to back out of the deal, or to withdraw their application, or to not pay the first premium, or to change their mind.
Correct.
And I think that goes to a placement issue rather than a persistency issue. And oftentimes placement issues are you're pushing something through, and for a variety of reasons, it doesn't get placed at the carrier and issued, and the first payment never actually gets processed, and the policy never goes in force officially.
Mm-hmm.
I think
Good news with that is it's you never really get a chargeback because you don't get paid the money.
and that's not always true.
Well, if it's never placed.
But see,
If
we get
it's
the
never
approval
placed.
rates. We get the approval rates. So we get carriers in the simplified issue space, Zach. You know that there's a lot of final expense companies out there that will actually go ahead and advance on approval before it actually hits the pay date.
Right, but the approval is a placement.
But it's not issued until the
It's
money
not- it's not
until the
issued.
money's
You
applied,
said
right?
you said it's
Till the money's applied. And so that's where it gets tricky for agents. And so agents are going, hold on a minute. So there's companies out there. If you're watching this for the first time or listening for the first time today, there's companies out there that will actually pay once the underwriting group says this policy is approved. And they process it through, and they actually release commission. And they actually haven't received a payment because you've got the payment set for the next month. If it's like a senior's policy and they're 65, 70 years old, and you're processing their first payment on their Social Security pay date, which is the 3rd of next month, the insurance company hasn't received a bit of money. You've done your work, and they've advanced you a commission, and no money's been received by the carrier. So that's a little gap that sometimes when people are first getting into the industry, they don't realize. There are plenty of other carriers that only pay on first draft. So that first payment has to hit the system before that company will release a commission. Most traditional life insurance, term products, whole life, most traditional products, they're all like that. Like that first payment has a process. So there's like this little this extra little gap or this extra little opportunity for placement issues that exists in these senior products that I think don't exist in traditional fully underwritten products or traditional insurance products.
I think it'd be helpful for the agents who are listening to have maybe an understanding that there is a possibility of reducing those numbers. You know, like it is helpful to know, hey, I can turn this dial and maybe you're listening to this and you're like, man, I'm getting drilled. I had this many chargebacks. I wrote 5, I got 7. That'd be really bad.
Well, there's definitely some problems there.
Yeah, if you wrote 5, you got 7. But what are some of those dials? And I think you hit on one of those, Roger. You said push it through. Push it through. What did you mean by that?
Well, one of the things that we see from exuberant salespeople, that's a term that I'll use, exuberant. People who sell on energy, who sell on enthusiasm, and they're not listening to the client. They're selling on their passion and excitement for the sale. They're trying to close deals, and they're pushing sales through. They're not hearing. They're not actually identifying and meeting a need. They're not establishing enough trust.
Yeah.
You know, they're not doing the work that goes into becoming someone's advisor, and they're pushing sales through. You see a lot of those deals fall off very quickly. Some of those are placement issues. As you know, Zach and I were talking about this word called placement versus issued. And we see a lot of those not even get issued at all. And so we see agents that go out and write $12,000, $14,000, $16,000 in business, and we look at how much was issued the next week or the next month, and you realize out of that 12, 14, 16,000, only 4 or 5,000 got issued. But what happened?
That's called an emotional chargeback, Roger.
Yeah, well, it's an emotional and a literal one, both.
It's not always a literal one, because they in that situation, a lot of those people aren't really making the money they seem to be making, because they're and I call it an emotional chargeback, because in their mind, if they feel like they got a commitment from the client and they feel like they're just pushing through, in their mind they've made the sale. In their mind, that money's in their pocket. Right?
Especially if they posted it on social media already.
Yeah, they're posting numbers.
Yes.
They're on leaderboards, which all that is based upon submitted business, which is simply just turned in as a potential sale.
Right. It is what it is. I submitted it.
Exactly. Exactly. But the agents, what's hard about that is they're almost counting their chips. They're almost counting, this is how much money I made this week, when really they didn't get any deposits. But when they say this is how much money I made, and unfortunately, if some of those don't go through as if they thought they would have, then they feel like that money's ripped away. But in reality, it never got to them.
They never had it, but they felt like they lost something they never had.
That makes sense.
Yeah.
It does.
So we'll say on the one level, we'll talk about hard closers may experience a higher chargeback ratio. It doesn't mean it's going to be high, but it may be higher. It's something to pay attention to paying attention to the need and building trust. Those would be two big aspects of that, right? What about you, Zach? Like, what are some ways to turn the dial to mitigate some of these?
Well, it's just continuing to learn and have the desire to get better. I mean, nobody has been through this, and I always believe as a new agent, like for me personally, I'll tell you my little first introduction to chargebacks, because I did get some. But I was always, I started off and I was mentally wanting to be the best I could. And I had some early success. And I tell every agent what they first start doing is their stages of learning is, one, they learn how to sell insurance, learn how to sell a policy, learn how to get a sale. Doesn't matter how big, doesn't matter, they don't have all the techniques. They got over that hurdle of that win. The second major stage is you learn how to sell a lot, right? Now you're putting up big numbers and you're like, wow, this is great. The third stage is you learn how to sell the right amount. And that comes into play when really dialing in and having the ability to figure out exactly what they need and pairing the right product and the right price for that client, instead of selling a lot. And not really focusing on the need and what's really there. And I'll tell you, I had it was probably a month into the business. I had my first week where I wrote over $12,000. And it was all with one carrier. I was just so excited because, I'm just smiling and, I'm going. And
You made $12,000.
No. The commissions were a lot different back in the day. But
Yeah.
but I knew I was going to make a significant amount of money. And it just so happened that there was, I ended up getting a little over $250 from that. And that was an awakening from me. And I had to really learn why that is. And a lot of that was, and I know you're probably going to allude to it, but what happens in those first 3 months as a new agent and all of these occurrences of the different ways you can get a chargeback. And then when they all kind of hits you right at that newness of the business, right at about 3 months in, or right about that 90-day period. And it just happened to be right around that same time. And I'm sure everybody has their own little story of that, but that really helped me to dial in and focus. Now I know how to sell a lot, but how can I sell the right amount and really know that I'm making a difference?
It knocks a lot of people out of the business.
Yeah.
That 90 to 120 day window right there. Because they're running hard and all of a sudden their bank account's going the
They're
other.
spinning hard too.
Yeah, they're going the wrong direction. You're working hard, you're investing in leads if you're on a lead program, and
Yeah.
you're rolling and you're thinking deposits are going to keep coming like they have been for the first 2 months. And now all of a sudden, like reality hits. And why do they hit in month 3? That's I'm going to throw that question back to you, Chris Ball.
Right.
Why month 3? We're talking about 90 to 120 days. Why are they hitting then?
The carrier typically doesn't roll them in until 2 months afterwards, correct?
So let's just play a
Sound
scenario.
like you asked us a question.
yeah, that's.
that was smooth, wasn't it?
I know.
I don't ever get them. So
And he threw a tat out on it. I like that.
I know.
But let's play a
Correct.
scenario. Let's say you go out there and you're in your first month and you sell a policy to Miss Donna, okay? And you set up Miss Donna's policy to start, let's say it's the middle of the month, and we're going to have it start on the 3rd of next month, because that's when she gets her Social Security, which you should be asking that.
Mm-hmm.
But we set it out for then. We're excited. The health is good. She got approved for it. But one reason or another, the payment doesn't go through. It could be a variety of reasons. It could be I set it up on the wrong date. It could be that I overextended her budget. There's a number of reasons of why, but one of the reasons it just doesn't go through. Or let's say the first payment does, but the second payment doesn't. It's going to have typically a 60-day lapse period beyond that before the chargeback is going to actually hit you if the policy has been in force. Because there's conversion opportunities to be able to save that business. And a lot of new agents, they're running so hard. The worst thing about a new agent is they never check their email or follow up on their business.
yeah.
And they're running so hard and pushing forward that they may see an email or something come across that says, oh, yeah, it's pending termination or pending lapse.
Conservation event or something to that.
But the financial aspect doesn't hit you yet, right? So it typically, all of those things, the result of your one chargeback is going to be 60 to 90 days from the time it actually occurs, from the time you wrote it, even if they don't pay or it falls through. But when you do that as a beginning and it kind of piles up on you and it hits you all at once, and you're right at that 3-month mark where you feel like you're the king of the world. You're so excited. You have so much enthusiasm. You started a new career.
In month 4, you can't even get your head above water.
Exactly. You already went out and bought a new car. Like you've already
You paid off your credit card.
Yeah.
Exactly.
You got all your expenses paid
Student
down.
loan debt gone.
Yeah, on all borrowed money from the clients that no longer are on the books.
Right.
So now you get left with
Yeah.
this large amount of chargeback and debt liability. So now you're writing policies
to cover the debt.
to just get back up to level ground.
Yeah.
When the payment doesn't go through, so you write it on the 10th of this month. If it's a senior or a final expense policy, you put it on the 3rd of next month for the first payment date when they get their Social Security. 3rd of next month, the payment doesn't go through. Then the insurance company reaches out saying, we missed your payment. And then it goes for 30 days. They're
For a
trying
grace period.
they're trying to capture that. And then after 30 days, they send a notice, termination notice, that unless in the next 30 days they collect it, if the policy is terminated. And all of a sudden, that's that 90-day window that we talked about
Right.
approximately. And if you write enough business and you have a bunch of those fall off, the first time it hits is in that first 3 to 4 month window. So,
and it's when you're mastering your craft, you're trying to make these adjustments, you're finally getting some sales, but you don't know why you're getting sales.
Yeah.
That's I will tell you, like, this episode can't live in a vacuum. It really needs to. You really need to pay attention to the sales process, how we discover need, help them verbalize their need, build trust, share a belief statement, all those things. There's a reason why we say these things, and it does help you keep the business. You guys did refer to this a couple times. For final expense, you said the Social Security date. Why is that such a big deal?
Well, in final expense, the market we serve are a very limited income. And most of them are on Social Security or disability, which means their income comes in usually once, maybe twice a month if they have a pension or something else. And that's about it. When all of their bills come in at the certain time of the month and they only have basically one shot a month of income, they take care of everything they have to pay for the month kind of all at the same time.
They're going to find a way to afford what they need to afford.
Exactly right. But if you're setting up a payment to come out on the 9th of each month, there's not going to be any money left in the account because they're so focused on taking care of their biggest needs and necessities at that moment, right when they get their money. And if you don't take care of a necessity right when they get their money, they forget about it. It's not that it's not important. There's just not enough left when that comes around.
yeah, it's always good to process the pay date when they're receiving their funds. Clearly, if you set it up for the 9th or the 10th or some other odd number and they get theirs at the beginning of the month, if any other thing happens, right, and they need money for, they hit that account, not thinking about the $62 that they still got to pay for their life insurance policy. Likewise, I mean, if you're selling a mortgage protection client, you set them up over the phone, and you one of those people who say, now, when would you like your first payment set up for? Right? You're actually inviting an opportunity for a non-placement right there, just by saying that. So a better way to say that would be, so once this policy approves, they're going to draft your first premium and put the policy in force. And then after that, if you need it set up for a certain date of the month, we can set the date. Fair enough? And then they go, yes. That way, they know, okay, in the next few days, this payment's going to go through, and it might be $120 a month for that mortgage protection plan. Now you've got it set up. Typically, if they're going to change the date, they want it changed to a date when they get their paycheck. So the 1st of the month, the 15th of the month, every other week, you know what I mean? Like how people get paid, and they put it on one of those cycles. But usually, even all of us, I'm sure if we've got any kind of payments that we make on anything, even on our utilities, is typically set up around when we're receiving our payments. So it's a human behavior, common sense thing to apply.
And I think it makes sense the way you just said it. And like for most of us, we have our utilities, our other bills, they come out, they do draft automatically. I don't think about those. I think most people, when they're automated, they don't think about those types of things. And your life policy needs to be on that payment, because if you don't want them thinking about that payment.
Yeah.
Right. You don't
want the payment too big for them to have to think about it.
Right.
You want it to be comfortable for them, and you want it set up at a time that's convenient for them, so they don't even have to worry about it at all, ever again.
Absolutely.
It's done.
Yeah. So we talked about the affordability, building trust, all those pieces, getting on the correct draft date. The one thing that is true, we started this conversation off. Yes. The one thing we did talk about at the beginning of this conversation was, is it unavoidable? It can be mitigated. I don't know if it is unavoidable. There's always going to be weird conversations,
Well, life isn't unavoidable. Like things happen to people. They get sick. They have other people in their families die. Like life happens to all of us. Life happens to our clients as well. And unfortunately, they can't continue to pay their policies sometimes for whatever circumstance it could be. It could be a major flood that hit, and they lost their entire home and everything. I mean, a tornado came through. Those are two big events that just happened in Kentucky, like within a year. Those things can wipe out, and we can't control those. But if we know that they're going to happen, and I was guilty of this at the very beginning, in that learning stage, is I didn't know what to do when it did happen.
Yeah, that's a big question, is if it does happen, what do you do? And one thing that you guys alluded to earlier, it's important to pay attention to, is pay attention to your business. Those emails come for a reason, right? They're letting you know there's an event that is happening that you have to pay attention to, because it's going to affect your finances. So
Some of the companies still send you an envelope with a letter in it that says that.
Yes,
so you
they
have
do.
to open envelopes and open the mail. I mean, it's still
Yeah.
a thing.
Yeah. And I think there are some agents who do not pay attention to their business and think, I'm just going to outright this. I'm just going to keep
Here's the other
outrighting
thing.
this.
I paid attention to my business, and I still said I was going to outright this because, and I don't know why, but the fear I had was they canceled because they didn't like me. That was literally it, and I couldn't get over that. Like I didn't like that. I didn't want to make that phone call because they weren't going to answer, or they were going to cuss me out. And I don't know why, because I felt like I had a great connection with all of them. But that internal fear prevented me from just picking up the phone.
Wow.
And what I learned was the easiest policy to sell is the one you've already sold.
Amen. Very good.
It is so crazy. And if you just pick up the phone and just say, hey, Mr. Chris, I don't want to alarm you or anything, but I was actually coming through and I had a notification that came across that your policy is actually in pending lapse, and I know this was really important to you to take care of your wife and kids. I just wanted to make you aware of that so we can get it fixed. Oh my gosh, is it really? I don't know what happened. What's going on? And I was like, well, let me confirm everything we had here. And a lot of time it was simple. They gave me a wrong bank account number or something just goofy. Or sometimes the carrier makes a mistake on the way they enter the bank account number, even if it's on the policy correct. Like, just investigating that, and I promise you, at least 60% of the phone calls I made had no idea that it canceled, and they were so worried, and they needed to put it back away immediately.
Yes.
60%.
Yeah.
Just from getting over my own internal fear of just calling them.
That's huge,
It was
man.
crazy.
The other thing I've learned through this and calling folks about these conversations is people will cancel their policy before they call and say, I can't afford it. Even if you worked out the affordability, but like you said, Zach, life happens, these things happen.
Yeah.
Something happened, but they still can afford something. But they don't want to face that embarrassment. And it's a human nature thing, right?
Yeah.
So they'll just cancel the policy.
I think that's another 30%. 60 don't know. 30 is scared because they overextended themselves. So those other phone calls is what if we just bumped it down to here so you have something? Something is better than nothing in place. And we know it's important to take care of. That was probably the other 30%. And the 10% you never got a hold of, or they
I don't want
it. Right.
Yeah.
That's reality of what it really is.
Yeah. It shouldn't be 50%. It
Yes.
should be more like 10 to 15%.
Yeah, and even in those conversations, you can learn how to improve. Like if you are getting more than 50% to say I didn't want it when you're talking to them, then there's a sales process issue.
Yeah.
Like there's so much information here in helping you get better,
And we
keep
can help
more
you
of
with
your
that too.
business. Oh yeah.
Well, just up front, I mean, let's leave some takeaways before
Okay.
we wrap up this episode. So on the upfront, number one, you got to develop trust with your client. You got to know why they need this, and your client has to tell you why they need it.
Yes.
Because if the client takes emotional interest, if they emotionally own the value of this policy, it's very highly unlikely that they're going to cancel.
Yes.
Unless unless an error takes place, unless something like that takes place. And so sell to the client's need. Don't sell to your need. Don't oversell, like Zach was talking about. I learned how to sell a lot. What he meant by that is I'm overselling the client. I'm overselling their need. I'm just writing big policies. Woohoo, I got big numbers on the board. It looks fantastic on
Right.
social media. It looks great on the leaderboards. My name's getting recognized all the time. And trust me, there's plenty of those people out there. There's plenty of people that we've worked with that do that. And then when we do a deep dive into their numbers, we realize they're placing 50% of the business that they write. It looks fantastic, but the guy who's not doing so great is actually out earning them because they're actually more methodical. They care more. They listen more. They actually put plans in place and make proposals that are based on their need. And then the second piece to that is that they're finding an affordable benefit.
Yes.
They're finding an affordable benefit. I'm not saying an affordable price. They're finding an affordable benefit. That client might need a $200,000 policy to cover the entire mortgage, or $250,000. But the affordable benefit that client can afford might be a $150,000 benefit,
Correct.
right? It might be a $150,000 benefit, and you put that in place, and that policy stays in force. But the one for $250,000 or $350,000 or $400,000 may not, because you've oversold them based on their budget. And so you have to find an affordable premium/benefit for them to help meet their need. And I think if you have their trust, they've identified why they emotionally need it and why they want it and why they have value on it, And then you give them options to choose from that are affordable for them, that meets and fits within their budget. You've solved 2/3 of most of the issues that most agents will have.
Can I add one more thing to that?
Yes, 100%.
That trust in the beginning, getting them to like you as a person and understand you is so important. But going through everything you said and then reestablishing that trust at the end in a cool down phase, so it doesn't feel like you're writing the policy and running, like that can create a untrust or like a buyer's remorse out of like, boom, he wrote the policy, typed it, closed his laptop and going, I just gave him my bank account information. I just gave him my card information. And now he's gone 2 minutes later. Like, go back and do that cool down. Let them know you're human again. Take them back through, to the very beginning to where that trust is reestablished before you leave. That will, like the things Roger just went through, that is that the people that have less than 10% chargebacks or the persistency rating is above 90, these are the things that they're doing.
Yes.
Yeah. They're readdressing the value points. They're readdressing the affordability. They're making sure they understand you're going to be there if they have any questions.
Yep.
This is a process. I'm going to follow up with you on the next step. Once this gets approved or whatever the process is, I'll be in touch with you. Do what you say you're going to do. Stay in touch. Follow up. Be a human. That's good. Be the person that you would like dealing with you and in this situation for you and your family. Don't be a person who rushes through and just jams things through the pipe because you got to make a paycheck.
Yeah.
And that will solve two-thirds of the issues without a doubt. I was on the phone with a new agent this past week, and I was excited to hear on our call that we had this morning. I heard that agent wrote 4 policies on between Friday and Saturday, and I was on the phone and he said I've got all the way up, and the client wouldn't give me the banking information, but they gave me the Social Security, they gave me the address, they gave me their birth date, but they wouldn't give me the banking information. And my question was, why do you think they wouldn't do that? And he said, well, I wonder why anyone would ever do that with a stranger over the phone. Right? That's what the answer was. And I said, well, if that's your belief, right, that's an inherent belief that you have to overcome, number one, because you have to provide enough connection, enough value, enough trust to your client that you're not getting that at the end. And you certainly can eliminate that question in your own mind why anyone would do that, because we live in a modern economy with technology. It happens every day, right? And so you do have to learn to earn people's trust. So what are you doing to earn people's trust? What are you doing to improve that? One of the here's a little 1999 trick. We still got 1999 tips?
Yes, we do. Yep. This is
a 1999 tip from way back when we started the podcast. One of the things in this that COVID, I think the pandemic and the change in technology has taught us that when we're doing phone sales or a Zoom meeting and we're in a virtual setting or just at a direct telesale setting versus a face-to-face in-home, send them something up front. Like send them your digital business card at the outset. Hey, Chris, is this your cell phone number that I'm talking to you on? Great. Is this your cell phone number,
yes,
Chris?
Sir, it is.
Great. I'm going to go ahead and send you my digital business card so you have a copy of that. I'm going to put that in right now. I'm sending it. Can you just check your phone to see that you got that?
Yes.
And you can even hear their phone vibrate on the other side. And when they open it up, say, see that good-looking guy there in the middle? That's me. And there's all my contact info. You'll see my email address, our company. You'll see all the information about how you can get a hold of me. My LinkedIn profile's on there, and my email address and phone number if you ever need to get me. So also my license number's right there in this file. If you look, you can check to see my state license number. And I'm required to send that out to you just so that you know who you're talking with before we proceed any further, okay? Like that one thing, that one bit of information is establishing a credibility point up front that most other people are not doing. And people want to know that you can be trusted. So when you develop trust, you create affordability, and you listen, and then you put the plan in place, you've got a good shot at mitigating most of that. And then the rest is just following up after to keep your business on the books.
100%. Following up, picking up the phone, regardless of how you feel about it. I promise you'll have some great conversations.
Sometimes going slower is actually a lot faster.
That's right.
Slow down to speed up.
Slow down to speed up. Hey, guys, thank you very much. We want to catch you on the next Life Insurance Academy podcast. If you want more information and some resources, you can go to lifeinsuranceacademy.org. We have some goodies there.
Boom.
Boom. We'll catch you on the next podcast.